So unless you've been living under a rock the last few weeks, we have witnessed some pretty big cracks in the foundation of the US financial system. Obviously, with the collapse of SVB, which if you convert their US based assets to Canadian dollars, this is a bank that is nearly the size of Canadian Imperial Bank of Commerce, which is the fifth largest bank here in Canada. So this is a notable collapse in the United States. It rocked the financial world. Even as I film this, it is still rocking financial stocks. So a lot of people are wondering what the best opportunities in the Canadian financial sector are right now. And a lot of people are cautious when it comes to adding individual stocks. I've had a lot of requests for people who want to know what individual stock to buy, but I've also had a ton of requests of people who want to know what I'm doing on this dip, and also those who want to know how to take advantage of it on a broad base. And that is why in this video, I'm going to speak on some top Canadian banking ETFs, and I'm even going to expand it to broad-based Canadian financial ETFs for those who are worried about picking an individual stock, but definitely want to increase their exposure to the sector on the dip. So with that said, let's jump right into it. So I'm not exactly going to speak on my thoughts on the SVP situation. We did write out a 2,000 word plus mammoth article on the situation to our premium members. 14-day no credit card trial in the description below. You can hop on and read the article. Literally no commitment necessary besides a simple registration. So Canadian financial stocks are under a significant amount of pressure right now, especially the ones that have high US exposure. You're seeing companies like BMO and TD take quite a big hit, and actually we haven't seen this type of volatility in Canadian financial stocks in a very long time. Personally, I own 3 Canadian banks, major Canadian banks. I own BMO, Royal Bank, and TD Bank. I do not own CIBC or Bank of Nova Scotia, and I also own the smaller alternative lender in Equitable Bank. And in terms of insurers, I own Intact Financial. So, do I buy these Canadian banking ETFs? No, I do not own any of them, but that is not necessarily to say I do not like them. I definitely appreciate the convenience and also the broad selection that they offer people who either do not want to put the time into researching individual equities or are scared of essentially picking the wrong horse in the race. Now, you do pay fees on these ETFs. Some of them are pretty large fees considering the minimal amount of holdings that they do hold, but a lot of them are also cutting fees over the last while to make them more appealing to Canadians. There is going to be a very wide variety of ETFs in this video. I'm going to cover some that have preferred shares and bonds inside of them. I'm going to cover some covered call funds, and I'm just going to cover some straight up Big Six Canadian financial ETFs. So let's dive right into it right now with our first ETF from a fund provider you really wouldn't think of, and that is Royal Bank of Canada. And by the way, these ETFs are in no particular order. I'm trying to come up with a wide base to appeal to a whole bunch of watchers on this channel so that they can find a fund that might be good for them if they don't want to pick the individual stocks. So as always, if you're more of a reader, we do have all of this content available on our website, along with probably 500 other articles highlighting stocks, ETFs, all that type of stuff at stocktrades.ca. But again, Royal Bank. So they are not a very big fund manager here in Canada. They're more along the lines of mutual funds, so their ETFs are pretty rare, but the one ETF that they do have that has very affordable fees, as we can see here, 0.32%, is their bank yield ETF. So this ETF aims to track yield. This is a yield-based ETF, so it tracks the Selective Canadian Bank Yield Index. So you're not going to see this be an equal-weighted banking ETF or a ETF that generally tries to invest in maybe the most solid banks. Instead, you're going to get where it prefers yield. And this makes complete sense when you look at its holdings. We can see that Canadian Imperial Bank of Commerce and Bank of Nova Scotia make up half of this fund, despite being the worst performing banks over the long haul. And the reason why they're in this right now is obviously with it being a yield-weighted ETF, these two stocks yield the most. As price falls, yield goes up. So if these stocks were to outperform moving forward maybe, and the yields get a little bit closer, you might see the allocations change. But as of right now, CIBC and Bank of Nova Scotia are the largest weighted. And the one thing about this is Canadian Imperial Bank of Commerce, arguably outside of National Bank, has the lowest exposure to the United States. So that is something to consider, although they do have very, very heavy exposure to Canadian real estate. In fact, in terms of overall loan book, they are the heaviest exposure out of these six. So again, the fund has expense ratio of 0.32, meaning you'll pay $3.20 per thousand invested every year, and it's going to be one of the higher yielding bank-focused ETFs on this list. There is higher yielding funds on this list, but this one, focusing on just this big six banks, it's going to be one of the higher yielders. So assets under management of $241 million. Again, RBC is not well known for their ETFs. So this is not a very popular fund in terms of AUM, but $241 million. There is definitely no worries of this fund not existing anymore. It's got enough assets that they're definitely going to continue to run it. So in terms of performance, much like a lot of these other ETFs, we can see the fund is up 0.33% year to date. Over the last 1 year, obviously financials have taken a big hit. When we look to 5-year annualized returns, it is one of the weaker performing ones on this list, and that is primarily because it is yield weighted. It's going to invest in typically the weakest performing Canadian banks because they present the highest yield. So the next ETF on this list is probably my favorite ETF, and that is the BMO Equal Weight Banks ETF. It trades under the ticker ZEB.TO, and this is arguably the most popular banking ETF in the country. As you can see here, it's got assets under management of $3.5 billion, and it has had large inflows over the last while. We can see that over the last 3 years, this fund has nearly doubled in size with inflows of $1.6 billion. So this fund is really catching on. And the one thing I do want to note is this expense ratio. Y-Charts isn't picking up the new expense ratio. BMO has dropped this to 0.25%. There was a lot of scrutiny on this fund that the 0.5 expense ratio, considering the fact you could mimic this ETF very easily, especially on a commission-free platform, wasn't necessarily justified. This is primarily because if we look here, it contains 6 holdings. So who's going to pay, $5 per $1,000 invested when you can just buy these 6 holdings yourself and keep track of the fund and rebalance as needed. But now that it's $250 per 1,000 invested, especially because of the monthly distributions you can get from this fund, another added bonus, a lot of people have begun to take interest in it again. So this is an equal weighted bank ETF. So like we looked with RBNK, it was not equal weighted. It was an index fund, but it tracked a yield-based index. ZEB is an index fund in the fact that it tracks the BMO Equal Weight Banks Index ETF. So this is a BMO banking ETF that essentially tracks its own index. So when we look to holdings, we're going to see some of the better performing Canadian banks over the last while. This is contrary to RBNK. We see Bank of Nova Scotia and CIBC at the bottom of the weightings list. They're the worst performing banks, and we look to banks like National and Royal Bank, which have been the best performing as of late. Overall, you're talking about very, very little deviance. We're looking at 15.3% for CIBC and 17.5% for National. So when we go to performance, we can see again, it has carved out a little bit higher annualized returns over RBNK. I think that's about 50 basis points, 0.5% over the last 5 years. And this is, again, likely due to its weighting towards not necessarily yield-based, but an equal-based strategy. So this is probably the most vanilla banking ETF here in Canada. It contains an equal weight position of the big 6, and it's going to adjust accordingly relative to the index. So quick break from the video. Again, we can only make this content with the support from you, our watchers. So smash the like button if you like this video, subscribe to the channel so you can get access to more great Canadian content, and 14-day free trial of premium in the description. No credit card required. Let's get back to the video. Now, the next one on our list is ZWB, which again is also a BMO ETF, but it has a covered call variant attached to it. Now, ZWB is also a very, very popular fund. I mean, BMO has arguably two of the most popular funds in the country when it comes to Canadian banks. We can see with assets under management, $2.7 billion. This fund is very large, not as large as ZEB, but pretty close. When we look to the expense ratio of 0.65, this is a covered call ETF. It's going to have a larger expense ratio. It's a more actively managed fund. They have to sell covered calls. They have to make more transactions. And ultimately, you will pay for that in the bottom line of the fund. So the one attractive thing about this ETF right now is it has a trailing yield of 7%, and it pays this out on a monthly basis. So when we look to ZEB, I actually did not show you the yield on ZEB. It only yields 4%, also paid out monthly. So for those who want to own the Canadian banks but want a little more yield, ZWB is certainly a fund you could look at, especially if we were to hit a situation where Canadian banks, in the event of a recession or in the event of, say, a financial crisis in the United States, let's say Canadian banks trade flat for the next year or two, this covered call ETF has a chance to outperform ZEB and other popular Canadian financial ETFs and banking ETFs. It is a possibility. It is not a guarantee. I've highlighted this a few times with covered call funds. They are very far from guaranteed to outperform in a bear market. So looking to holdings, this contains much the same as ZEB. It actually contains 24% of ZEB. So this covered call fund, nearly a quarter of it is the non-covered call BMO banking ETF. But after that, we get much the same weightings as ZEB: National, Royal, Bank of Montreal, Toronto Dominion, followed by Bank of Nova Scotia and CIBC. The gist of this fund, it's going to own these banks and it's going to sell covered calls on them. And as a result, you are going to get more income from the fund. That's exactly why this can yield 7%, while ZEB only yields around 4% despite holding the same things. Now, if we look to performance of this fund, it has underperformed the other two banking ETFs by quite a wide margin over the last 5 years. I would like to mention again that this is with dividends reinvested. This is total returns. It's trailed RBNK and ZEB by about 2%, 2.5% annualized over the last half decade. This is quite a bit overall if you're a total return investor. However, if you are looking for income, it's definitely a viable option. And the one benefit I did say is over a flat or a bear market, we can see that, it's lost 15% over the last year, while the other two funds have typically lost, anywhere from 18 to 20. So overall, ZWB is going to be for those income seekers. It is not my cup of tea, but that is not to say that it is not yours. I do get a lot of criticism for kind of highlighting the pros and cons of these covered funds. Again, that is my opinion. Some people love income. That's your choice. The next fund that I do want to look at is the iShares Equal Weight Banc&Lifeco ETF. So we've moved on from the pure play bank ETFs, and now we're looking at if you want exposure to the Canadian financial sector. So this fund is going to contain everything from life insurers to P&C insurers to Canadian banks, all that type of stuff. So when we look to the expense ratio, 0.61, this is a niche ETF, and it is also an actively managed ETF. This is not an index fund. So when we look to the holdings of this fund, we can see that it aims to take a position in 10 financial companies, mostly with an equal weight strategy. So we can see National Bank being the largest holding at 10.3, but we can also see that TD Bank is the tiniest at 9.4. And we can see other popular, very, very popular insurers: Manulife Financial, Great-West Life, IA Financial. The one thing I did mention actually is P&C insurers. I had thought this fund contained Intact Financial. It actually doesn't. So it does not have a P&C insurer. So this is mostly in terms of insurance exposure on the life and managed product end. So in terms of performance, the broad-based nature of this fund, along with its active management, has actually led it to perform quite well. We're looking at annualized returns of around 7%, which is the best performing fund on this list thus far. And when we look to year-to-date returns, it's actually green on the year. And that is because insurers haven't necessarily been hit as hard as banks. Just the overall situation in the United States when it comes to the SVB collapse, the First Republic pending collapse, the European financial crisis, banks have been hit harder. So it's not really surprising to see a ETF with an equal weight exposure to some insurers and some banks perform better. So if you're looking for more broad exposure to the Canadian financial sector, it's definitely going to be a fund that you want to look at. In terms of yield, I didn't really talk about the yield, but it yields 3.69%. So it is one of the lowest yielding funds on this list. If income is your priority, you'll definitely have to take this into consideration. So the next fund is actually a very unique fund, and it's one that could potentially have some outsized potential moving forward, even in the midst of the banking uncertainty, and that is FIE.TO. This is the iShares Canadian Financial Monthly Income ETF. So what do I mean by outsized potential moving forward? Well, this is the one fund I was talking about that contained fixed income exposure to both preferred shares and to bonds. So before I get to that, though, let's look at the expense ratio of 0.81%. You will pay $8.10 per thousand invested. This is the highest fee on this list, pretty close to. I think one of the covered call ETFs might have had a similar fee, but it is expensive because this is a very, very niche ETF with a very specific strategy. So assets under management, 893 million, and the objective of the fund is to pay a consistent monthly income. We can read here the investment objective is to maximize total return for unit holders consisting of distributions and capital appreciation, and it aims to pay a stable stream of monthly cash distributions of 5 cents per unit. So that works out to be around 60 cents a year. And when we look to the trailing yield of 6.68%, the forward yield, especially at these price points, is much higher. You have to think we're paying a 60-cent distribution every single year on a share price of $6.59. So that is something to consider. So when we look to the holdings, this contains two large holdings at the top. It is the iShares TSX Preferred Share ETF, and this fund, if we go into it, is going to contain a lot of preferred shares on the Canadian banks as well as other major institutions. So we're talking Enbridge, Royal Bank, TD Bank, Bank of Montreal, TC Energy, CIBC, Fortis, National, Brookfield Property. So the main focus of this fund, 20% exposure, is going to be on preferred shares on pretty much blue chip stocks. Next up, we have the Canadian Corporate Bond ETF, XCB, and this is going to contain large exposure to Canadian bonds. If we look to the holdings, again, we're going to see Bank of Nova Scotia, Toronto Dominion, Royal Bank, Bank of Montreal. So this is going to be a very bank-heavy focused bond ETF. So as we know, or if you don't know, bonds have an inverse relationship to interest rates. So last year was arguably the worst year, actually not even arguably, for the 60-40 equity to bond portfolio. It was one of its worst years in existence. And that is because interest rates rose so rapidly that bonds took an absolute beating in price. So now that bonds are depressed in price, interest rates seem to have capped. It's far from a guarantee, but by the looks of it, the Bank of Canada has paused. If this is the case and interest rates start to come down, we should see bullish movement in bond prices and preferred shares. So with this fund having 30% exposure, something to consider. Outside of that, it's much the same as a lot of funds on here, but it does contain a lot more holdings. This is a more broad-based ETF. We can see, the typical Royal, Bank of Montreal, Manulife, but it does have companies like Power Corp, Dream Industrial REIT, Sun Life Financial, Equitable Bank, CI Financial, Artis Real Estate. So it's a bit wider range. So it includes banks, but it can also help you out in other areas in terms of insurers, preferred shares, bonds, things like that. So in terms of performance, this fund is not the best performing. It's much the same as ZWB with 4.4% annualized returns over the last 5 years. I think this is really impacted and quite possibly a little misleading, typically because of the bond exposure. Definitely not misleading. Returns are returns. But Moving forward, I would expect this to post stronger returns if rates flatline or do start to come down because of the bond exposure. The bond exposure in the past has hit the fund hard, and bond exposure moving forward might propel it to outperform the other funds on this list. Year to date, it's up around 2.6%, so doing quite well. And 3-year annualized, it's not performing as well as the other bank ETFs on this list. So something to consider if you've been considering a fixed income position is FIE. The fact it pays out a set monthly distribution is definitely going to be appealing for a lot of people. So the last ETF I want to get to on this list is XFN, and this is the iShares Capped Financials ETF. So it's a pretty big fund. Again, 1.4 billion in assets under management, and fees are around 0.61, $6.10 per thousand invested. Now, the yield, it is the lowest yielding on this list at 3.23%, and this is a index fund aiming to track the S&P TSX Capped Financials Index. So in terms of holdings, we can see why this is the lowest yielding fund on this list. Royal Bank is 21% of the portfolio, followed by Toronto Dominion at 17-ish and Bank of Montreal at 10-ish. So these are the 3 lowest yielding Canadian big banks. So if CIBC and Scotiabank were at the top of this list, you would definitely see this fund yield more. But with Royal Bank making up, 21% of the portfolio, it's definitely having an impact on the yield. And a lot of the higher yielding companies, CIBC, Manulife, Sun Life, Power Corporation, Brookfield Asset Management, they don't have very much weightings, and as such, it isn't influencing the yield. However, the fact that this fund has had exposure to the strongest performing Canadian banks over the last while has definitely resulted in it outperforming funds like ZEB, ZWB, and even RBNK. Now, not by much, by about 0.75%, but outperformance is outperformance, and it's definitely done so in the past. iShares, being from BlackRock, it's a very reliable fund provider, and overall, this is going to be more of a total return type of fund. It does contain a wide amount of holdings. We're seeing, again, in this fund, P&C insurers, we're seeing Fairfax Financial, again, Power Corp, asset managers, Brookfield Corporation, which is, renewable energy, pipelines, all that type of stuff. We see TMX in here, Element Fleet Management. So this is more of a total return, lower yielding base to get you total exposure to the financial sector. So that's pretty much it. I really hope you liked the video. I tried to go over as many funds as I can. I know this video probably went on for a very long time, but there's something in here for everybody: yield-based investors, total return investors, and if you're looking to take advantage of the dip in the financial sector but don't want to pick individual stocks, these are great options. Again, smash that like button, head down below, subscribe to the channel, comment, let me know what type of bank ETF you own, what individual banks you own, if you're buying banks right now in light of the uncertainty, and what you're looking to do next. And we'll see you next time with more great Canadian investment content.